Elon Musk doesn't like the tax cuts talked about in the big, beautiful bill, but presumably the markets will really like them. My name is Mark Williams. Joining me is Francois Savary. Francois, hello.
Hello, Mark.
Thank you for joining us. The US markets, they're not very far away from their all time highs, although they're underperforming the other global markets, apart from Japan, I think. But presumably, markets are waiting for these tax cuts announcements going through the Senate at the moment, and also the finalization of the US China trade talks. Do you agree?
Yes, I think that those are two elements that are impacting the market. I'm not sure that they consider that the big beautiful bill is as beautiful as it seems. You have a lot of question about the fact that it is going to increase the debt of the United States down the road. But nevertheless, I think that the market, you're right, is buying the fact that the relation between China and the US on the trade front is on the right path and that over the coming weeks we should have some agreement. I think that this is something that is really, really impacting positively the market. I still believe that there is a little bit too much complacency in the way people are looking at things. As I mentioned earlier, when you look at the level of the 10-year bond in the US, 450, it tells you that people have realized that there will be an issue of financing this big, beautiful bill in the medium term, in terms of we are going to see the fiscal, the budget balance in negative territory for quite a long period of time.
I want to talk about real interest rates, but a little bit later, in fact. When are we going to start to see the effects on the economy of the tariffs policy in the US economic numbers?
Very good question. I think that last week we had a few signs that it's slowing down. The ISM numbers that came both for manufacturing and service were lower than expected. And I think that this is the first sign that you really have something that is cooking. You also had the fact that the jobless claims were higher than expected and moving upwards. Nevertheless, what was interesting on Friday is that the non-farm payroll numbers surprised the market upward. They were better than expected. So I would say for the time being, you are right. There are limited signs that there is a slowdown in the US economy. Nevertheless, you have some signs that are telling you that you should not expect an acceleration of economic activity. You should expect a deceleration in the coming quarters.
I think we're expecting CPI numbers this week. What is that going to say about real interest rates? And are we at the highest we've been recently?
Okay, first of all, the numbers are very interesting because they are going to be the first number that are going to show the potential impact on of the tariffs on inflation in the US. Because now we have, with those numbers, the reality of the economy in terms of inflation. So I think that people will look at those numbers very carefully because there were a few signs in the last few weeks that people tend to overlook, and I think that it needs to be considered. First of all, when you look at the productivity numbers that were published for the first quarter, the final number of productivity numbers for the US economy, it was much lower than expected. And unit labor costs were much higher than expected. It tells you that you have something in the US economy that is not satisfactory in terms of inflation for the medium term. It was also confirmed by the job report on Friday, where average early earnings were higher than expected and moving upward. Those are factors that people need to keep in mind and they really should not overlook them. This is the reason why the CPI number and the PPI number that are going to be published this week are so important to my point of view.
The Chinese exports to the US have just been announced for the month of May, and they're showing a drop of one third, which is a massive drop in just 1 month. If the last US GDP number was affected by too many imports from exterior, surely a drop in imports is going to have the opposite effect, and US GDP is suddenly going to take a jump.
You're perfectly right. And we had the number coming from the trade balance that were published last week for the US. And the deficit went from 145 billion a month earlier to 85 billion this month. So it's already telling you that your argument is perfectly correct. Nevertheless, there is something that people need to keep in mind. The movement for the GDP in the second quarter is going to be a positive movement from a very low number in the first quarter. We will see a rebound in economic activity as measured by the GDP because of the effect that you mentioned. The imports are going to be much lower in the course of the quarter. That's not the main issue. The main issue is what kind of economic activity will we see in the US in the second half of the year? And there, I still bet that there will be some slowdown in economic activity. You had those numbers that I mentioned earlier. The ISM number, both for service and manufacturing, were lower than expected, below 50, which is the mark that tells you that there is expansion in the US. So you need to go over the second quarter and look through indicators that are going to show you the economic activity in the US for the second half of the year. And as a matter of fact, if the administration in the US wants to pass the big beautiful bill, it's because they know that they need to support economic activity.
Incidentally, Donald Trump is making a speech this afternoon at 4 o'clock. I imagine that's on domestic issues. So I'd have thought he's going to be talking about the big beautiful bill, surely.
That's quite possible, or it's going to speak about what is happening in Los Angeles and the fact that on the domestic front now you have the intervention of the National Guard in California. I think that this is also some issue that is going to be addressed this afternoon, to my point of view.
Coming back to the non-farm payroll numbers on Friday, do you think that and a big jump in US GDP numbers would be enough to prevent the Fed from dropping their interest rates even in September, as is now expected, rather than June, July?
I think that more than the economic activity, the Fed is not going to be happy with the number they saw on the inflation front. The number I mentioned on productivity, on unit labor cost, the average early earnings, which went up. I think that for the Fed, they have all the reason to postpone any rate cut, at least until September. And it's more on the inflation front that the question is going to be decided if they need to act or not. And I believe that recent comments from Fed members all tell you that they want to have more visibility on the inflation front before acting on interest rate. And now I reckon that you can consider that maybe there will be only one rate cut in the US by the end of the year. I was expecting two before, and it's not going to happen before the fourth quarter of this year.
Francois, I think that's all we got time for. Thank you very much indeed.
You're welcome. Bye bye.
See you next week. Bye-bye.
Bye bye.